Now, recently, my colleague Tumisho Grater spoke with Sias Esterhuizen, the Chief Risk Officer at the ECIC, on the role of risk mitigation in the current macroeconomic environment on the continent.
We've got two elements that, in terms of that, expose our business to risk, which would be an economical risk to the projects that we are providing insurance on, or the political risk in the relevant country that that project is taking place in. So we've got a research, economic and political research unit within the ECIC that constantly have tabs on what developments are there in the various countries we've got exposure in. So we've got a good feeling for what the current environment looks like in that country, and that helps us assess the risk when our underwriting unit would bring a new opportunity to us to assess and to identify, is there something that we can take on. And as part of that, there will be financial models that indicates what the commercial exposure would be for that project. So, and that model obviously gets interrogated a lot by our teams to try and assess, is that model robust enough in terms of the assumptions that goes into that model. I mean, recently the resource levels of resource, the pricing of resources that we're currently seeing at, that obviously puts a lot of strain on a lot of these projects. So we would look at stressing those assumptions in those models, making sure that they're robust enough for the project to even be viable should those prices not be achievable, or should the market change and those prices be something different. We've also got a risk unit that then would also challenge a lot of those assumptions that gets built into those models to make sure that those are robust and there was an independent view on those. And tying in with that, so a lot of people see legislation as a negative point. Yes, we are a short-term insurance company regulated by the Financial Services Board, but we see it as a positive thing in terms of the new solvency regime that the FSB is rolling out. That solvency regime is quite a robust capital calculation, which looks at ECIC's underlying exposure and concentration of that exposure in certain industries or certain countries. And then in that capital calculation, it infers to us what is the risk that we are exposed to and what capital levels do we need to hold to make sure that we will be sustainable should something go wrong in one of those countries we've got exposure in.
Sias, you mentioned that there are certain assumptions that you have to make, for example, the mining sector with the commodities cycle. Would you say that there are certain sectors that you're exposed to that attract a higher risk?
Yeah, so we are exposed to across a number of resources, be it coal or be it copper. Currently, our exposure in those areas are more on the political risk side. So the projects that introduced those risks onto our book, the guys just took out political risk cover. They didn't took out commercial cover. So it does mean that from a commodity price point of view, we're not that exposed, because a political risk wouldn't necessarily occur from the commodity price being under strain. But yeah, so there are a couple of commodities that we are exposed to.
You mentioned legislation not necessarily being a negative thing here, with the FSB looking at the robustness. But if we look at legislation from policy, stability standpoint, how important is it? And you are doing, business across the African continent, different regions, different policies, different legislation.
Yeah. No, it does complicate it, and it is an important factor for us to consider, probably more for our clients to consider. And I think that might be also a bit of where we can bring value to our clients, where we've got a lot of our teams would join the South African delegations to various countries. And when they're in that country, they speak to all the relevant people and identify what's going on, what is the actual sentiment on the ground, rather than just relying on news articles and so forth. So it does mean those units can then come back and engage with South African companies and give them a better feeling for where legislation in those countries are moving towards.